Hi, everyone. On behalf of the Counselors of Real Estate, welcome to this presentation of the Year in Review. What's past is prologue, or is it? Thank you for joining us. I'm Jonathan Schein, CRE, also CEO and founder of the Real Estate Limited Partner Institute in New York, better known as RELPI. I'm joined today by Victor Calanog, PhD, and also a CRE. He is the Managing Director and Global Head of Research and Strategy for Real Estate Private Markets at Manulife Investment Management in Boston. The Counselors of Real Estate is a global organization of commercial property advisors and has long been a beacon of thought leadership and problem solving in our industry. The organization's strength lies in the diversity of thought and experience among our distinguished members and those that have earned the prestigious CRE designation. You're encouraged to utilize the Q&A feature should you wish to submit a question. Your participation is welcomed and we'll answer as many questions as time allowed, and you don't have to be a counselor of real estate to ask a question as well. Welcome, Victor.
Hi, Jonathan. I feel like we just did this yesterday, but that was apparently a year ago, right?
It was a year ago. We were supposed to do it in December, but unfortunately, the flu season caught a lot of us. But welcome, so glad you're here. And we're now towards the end of January of 2026, and it already feels like we've already packed a year into this particular month. So
Yeah,
with that,
I'm tired already.
you're tired already. It's time for another holiday season. So why don't we get started? Why don't you kind of give us a place on the map where we are currently?
So I think it's useful to just look back at some of the key indicators in my mind of how commercial real estate and the overall economy performed in 2025. And unfortunately, depending on your political persuasions, it was either an amazing year or it was quite the challenging year, right? And so we're not going to talk politics necessarily. So I'm going to
No, no.
give you some of the numbers, right? Some of the good numbers are that with a 4.4% annualized GDP growth rate for the third quarter of 2025, we don't have 4Q yet, we're projecting anywhere from 1.8 to 2% GDP growth for the year, for all of 2025. It got rocky in the beginning. If you guys will remember, GDP growth actually turned negative in the first quarter as folks front loaded a lot of their import activities because of the upcoming tariffs. Everyone remembers April 1 or Liberation Day, right?
That
But
was fun.
why do I say this is overall good news? If we're ending at a 1.8 to 2% GDP growth for the United States, yes, that is a bit of a climb down versus 2024, but it is still well within what we call our long-term growth potential, which sits at around 1.9% for the US at this stage in its economic development. We're a $30 trillion economy. We can't be growing that much faster than 1.9 to 2%. So we're right there at that cost. By the way, what does that mean? If we grow below 1.9 to 2%, which I think a lot of folks were assuming or predicting that we would because of the various things and policy uncertainty and the like, potential trade restrictions holding back business. If we grow at below that, that doesn't mean we're in a recession, but that does mean if we grow below our long-term growth potential, things like resources, things like labor and capital will start becoming shaky. The unemployment rate will start rising, which it kind of began doing, right? We're still pretty low, let's face it. Sub 5% unemployment for the past few years, including 2025, is really nothing to call home about. But you could see that the labor markets have weakened pretty significantly. We're still above what we thought we'd be at. A lot of folks were projecting 1.3 to 1.5. So if we're growing at 50 bips above that, that is pretty good news. What's boosting that are basically two things. And I know you've read about all this in the Wall Street
Yeah.
Journal or Bloomberg, right? It's consumer spending. On average, we are still consuming quite a bit, although you can argue that a lot of it is the wealth effect, right? Poor households have been pulling back, richer households are carrying that average. Number two, it's related. Stock markets and equity values have done really well. Like if you just put your money in an S&P 500 index, you'd expect 16, 17% net of fees. So a lot of good things to think about, but still a lot of folks are feeling still 2025 was a period of high anxiety. And so, Jonathan, I characterize it as a curious mix of anxiety and resilience, right? The global
Well,
economy didn't collapse, did it? Like, yes, there were internecine wars. And gosh, that wasn't even 2025 yet, but there have been military and geopolitical actions that are roiling places in Latin America and NATO. Apparently, I can't be mentioning specific countries, I've been told, right? So it's pretty wild out there. But the US economy had chugged along, and I'll just cite one statistic for commercial real estate that was just out a day or two ago. According to MSCI, transaction volume is up 30%, right, for the US. And so,
Well, let me ask you,
yeah,
where is that transaction coming from? Because I mean, one of the big factors in the first part of this year and also last year is the dollar is sinking, right? The
yep.
dollar is sinking against other currencies. And so does that make US real estate more attractive? And is
Uh,
that foreign capital coming in to take advantage of the falling dollar?
well, I'd love to ask you, Jonathan, what you've been hearing from the RELP folks that might be looking at investing in the US or not. But what
Well,
we've been seeing, if you wanted to break down the 30% growth, a lot of it are the big portfolio sales. It's
okay.
94%. That grew by 9 relative to 2024 relative lows, right? The single asset sales, not quite there yet. So I think to your point, there is renewed emphasis on taking a look at what's driving what seems to be good averages, because scratch under the surface and you're like, ah, gosh, how sustainable is this? So, I mean, Jonathan, let me ask you, every week you speak to a lot of investors.
Yes.
Are folks who are outside the US thinking of investing in the US? I don't think I'm surprised that some of the Danish pension funds are like, no thanks, right?
The Danish pension funds, the German pension funds, they are all tapping the brakes. I mean, they know that at some point they need to invest in the United States because it is the most stable and best diverse real estate market there is. But currently, right now, and even the Canadian investors are just tapping those brakes. They just say, one of the biggest issues they have right now is one of certainty. And what are we going to do? Uncertainty around the Federal Reserve, uncertainty about our budget deficits, uncertainty about continuing resolutions to keep our government going. We're not looking as strong as we have in the past. And of course, we will again. I mean, I use that, of course, qualitatively, but we've been through these types of events before. But right now, the capital is not coming in as it had.
I really agree with you on that, and Jonathan, and my thought is, and this is not necessarily related to commercial real estate as a whole, although we cannot help but be concerned about it, is because of the way things in 2025 played out, because of the way the federal government made decisions whether to cut services, to defund some universities and some programs, to just reprioritize. I mean, that's their prerogative, right? To have
Yes.
a certain set of priorities. But the way it played out, my suspicion is there might be a long-term effect that might outlive this particular administration. And let me explain just real quick. A lot of the other policies could be reversed by another administration, but that feeling of, gosh, are we still able to rely on the United States as a reliable geopolitical partner over the long run for military issues and support? I don't know if that's been damaged for the near term and for many of our allies, right? And
Right.
secondly, if you're a university president at this point in time, maybe it's true that there probably were some inefficient programs that should have been cut, but the way it's played out is we've taken it for granted that for 50, 60, 70 years post World War II, the US federal government has always backstopped basic research in the United States that frankly has made us the envy of the world and has made our university some of the best in the world, right? Do you think university presidents still think the US federal government would be a great, reliable partner across? And I don't, if I was a president, I would be like, oh gosh, maybe we should rely on other sources of funding. What do you think?
I think that's quite possible. We don't know. It's still new. I mean, this administration is only a year old.
Yes.
And so a lot can change as they say, in a New York minute. Currently, the capital's not coming in. One of another issues that, and I know is part of the top 10, is immigration. I think this is the first year that we've had negative population growth, mostly because we have not had enough babies and enough immigrants. So you're talking about an unemployment rate there are still jobs out there. Who's going to fill them? And that's
And
another.
it's almost like here we're scratching under that surface of what I had mentioned as that is good news, right? That the
Yes.
unemployment rate stayed fairly low, sub 4.5%. But I think what you raised just there is very important because hey, with less population growth and less immigration, your denominator was not growing as large, leading to that rate staying stable, but should it have stayed stable if our labor pool were not shrinking, right? And coming off of a year, 2024, the US population grew by about 3.3%. I believe that was the strongest in at least 15 to 20 years, mostly driven by net immigration, right? And as you noted, that has reversed. I think folks are understandably worried about things like foreign capital and things like tourism dollars. I remember something caught the media earlier this year because of all the policy uncertainty. They had forecasted tourism economics, at least, and said the United States will be the only country out of over 180 to likely experience a decline in tourism dollars this year. That has not yet come to pass just because we haven't added up December yet, but I wouldn't be surprised if that were so. But what about this train of thought, Jonathan,
Yes.
oh, well, if you take a look at the numbers, only about 10% of tourism dollars are from international visitors.
That's
In
true.
fact,
I read that recently. I was shocked that that's
right?
all it
So,
is.
in fact, if you take a look at the US as a whole, if 90% of tourism dollars come from domestic tourism, right? And even in places like Orlando, because I had to look this up, didn't quite move the needle as much. It's 88% domestic, 12% foreign. You go to Disney World and you're likely not to hear Mandarin or Japanese being spoken. It's really mostly American families, right? Enjoying their
Yeah.
time because I don't know, there's a really great new Guardians of the Galaxy ride in Epcot Center, which I've personally ridden. So that's great and all. Is it okay for us to say, well, we've never wanted your tourism dollars to begin with? You don't want to come visit the US? We don't care. 90% of our tourism dollars comes from our own people.
Domestic. So we've set a backdrop. Okay, we've set a backdrop for our audience. Let's talk about where we go from here. Okay, what does investment look like? What does real estate strategy look like? What are the bright spots? And we're obviously going to go to some of the not so bright spots, but for the purposes of the counselors and all the others that have dialed in, where are the pockets of opportunity today?
So I'll share something that's been very consistent over the last 3 or 4 quarters. I think in the beginning of 2025, folks were a bit skeptical about it, but it's really played out based on the NCREIF Odyssey and NPI numbers. Retail appears to be back. So a lot of retail investments have been returning some of the most impressive total returns numbers, even relative to the other property types for 2025. In fact, the expectation for how long this will go for the next 5 years or so, PRIA runs an investor sentiment survey, as you know. Retail kind of tops the list, right? So, as a bright spot, I just remember, Jonathan, you and I have been doing this for many years. Gosh, how many decades was it that we were hammering on retail as
Right.
becoming the victim of e-commerce and Amazon taking over the world, right? In the meantime, yesterday, Amazon announced layoffs of 16,000 people, right? And so it's one of these interesting things which I think surprised folks earlier in the year. We made the call as well at our end to say we're not making massive real estate investments, but from a pivot point of view, gosh, we are looking once again at not regional malls necessarily, not public markets. That's not my sphere, but pretty solid tenant-based neighborhood and community shopping
Grocery anchored.
centers, right? Grocery anchored, pharmacy anchored, solid tenant base, good WALT, weighted average lease terms, and so on and so forth. So that's quite a bright spot that I think is a bit of a change from the usual, oh, we're investing in multifamily and logistics, right? In
Yes.
fact, I mean, we'll talk about them later too. Those guys aren't looking so hot. So at least in the near term.
Okay. So we do have a couple of questions and comments.
Oh,
How
questions and
does the
comments
soaring
already.
price of gold impact real estate and the dollar and fixed income markets?
Oh, so that is interesting. I don't know if I'd share this with you, Jonathan, but my lovely wife retired a couple of years ago.
Congratulations.
She's a very, very active mind, incredibly smart, far smarter than myself. I mean, I'm not being facetious here. She literally has a higher GPA than me in the same college we went to, which makes her so much more attractive to me than, if she had lower GPA. So she's great. She actually ended up taking jewelry making, right?
Oh,
And so she's been tracking the price of gold and silver pretty much every day for the last couple of years. It's been an incredible run, a record run. It's the same for silver, right? So it's not just gold. What appears to be underlying this is at times of high uncertainty and volatility, you tend to pile into perceived safe assets, right? So let me cross that with a couple of things. Number one, in the past, there was some correlation between US 10-year treasuries and gold, right? The yield would typically fall for high demand for US 10-year treasuries because more people are buying it, plunging into what's perceived to be the safe haven, right? Have you seen the 10-year treasury dip below 4% all of 2026? It dipped below 4% shortly in 2025, but it averaged 4.29%, right? Last I looked before we logged on, it was at 4.25. So folks are piling into gold, folks are piling into silver, that's what's driving the prices up. Folks have not been piling into long dated US treasuries. And for me, that is related to our earlier conversation, Jonathan, about gosh, what's the perception of the US's long-term financial viability if that's happening, right? I'm not skirting the question of commercial real estate because if your 10-year treasury remains at 4.243, right?
yeah.
And your average cap rate is still at around 5.25, right? Well, what kind of cap rate compression are you underwriting if you're looking at the 10-year treasury, your risk-free rate, right? Your floor being stuck there for the next 5, 7 years, if that's your horizon. That's
Yeah.
not what we're projecting necessarily, but we're also not projecting a big dip in the US 10 year, which means for real estate, gosh, the equity side is still being challenged right now. And the challenge being, if you can't rely on cap rate compression, which by the way, for the United States has driven about a third to 40% of total returns post
Yeah.
GFC, right? Yeah, I mean, you underwrite a deal, you know what happens when you change that exit cap rate projection, right?
Yeah.
Okay, if you can't rely on that, guys, for equity investments, are you really going to make those unlevered returns using income returns? Are you going to be able to raise rents that much? Because newsflash, for many multifamily markets, it might be negative this year. I think a lot of them were negative last year, right? So that doesn't bode well for income returns either. So I think I kind of tried to answer it in a circuitous way where we explained what might be driving this rise in precious metals prices and also its impact on CRE invest. By the way, because rates long term are still fairly high, that means credit is still looking pretty good, right? So I expect that private credit will actually have a good year or two of a runway. Unless again, I think things change because there is one situation where short and long-term rates fall, and that would
Yes.
be a big recession, and I don't think anyone wants that, right? So
No, you can't prepare for one either. There's no way to know when it's going to hit, even though you could have all the research in the world. If it wants to hit, it's going to hit.
it's very much psychological, right? This
Yeah.
is not a cop out. I'm an economist. It's my job to kind of forecast these things and assign probabilities of recessions, right? We're literally asked that, right? What's the probability? But that's the best we can do. We can only give probabilities. And as you might imagine, for example, on April 1, the probability of recession back then was about 45%, right? We're starting the year at around 27%. That's where we are.
Okay. So
And what
that
are the other questions we have?
oh the other was a comment that was regarding foreign capital in
Yeah.
tourism. Foreign tourists spend more than domestic, and that's really important in New York City. So,
Yeah, I mean,
well, with the dollar where it is right now, they're gonna even buy more.
yeah, I was being facetious about that comment about, well, foreign dollars only compose 10% of the total, right? But that tail does wag the dog, right? Like, I think a lot of folks think about the Great Recession as, yes, it was the worst recession since World War II. But when I asked them, what is the net decline in US GDP from 2008 to 2009? It was really only 4.5%,
Mhm.
right? During the Great Depression, like GDP fell by 10%.
Yeah.
Okay. So it's a world of difference. And I there's probably a curious symmetry here where I'm like, yeah, if the economy falls by just 10%, that's the Great Depression of 19, we wouldn't have the Great Gatsby without that, right?
Right.
So it changed the US and the world, probably led to World War II, right? So I'm telling you, if 10%, if our foreign dollar, if our tourism dollar falls by 10%, that is not something to sneeze at. I think that's my point too. And
Yeah,
for
sure.
the person that asked the question, yes, it is absolutely important at the metro level, even more so than at the national level. That this is going to be a bigger tail that will wag that dog of New York City.
And also we had an unemployment rate of 25%
Yes,
during the
during the
Great
Great, so
Depression.
the
And
GDP decline of 10 led to an unemployment bread lines. They're all in black and white these days, right? But you can still
yeah,
watch videos of them. It was a serious. John Steinbeck's novels are so grindingly dry and slow because he was writing about people walking to the bread baskets and
yeah.
starving, right? It was like a serious time. I mean, I'm glad that we could analyze these things,
In the past.
in the
And
past because I know we lived through a pandemic, right? We did.
we
And I'm
got
like,
here, we're done. Okay.
man, there are some really serious points in history where I'm glad we're here today. I would not want to live through the Black Death in 1348. I
Now that
mean,
would
no
be pretty
thanks. Just
sad.
no thanks. No thanks. I'm good. Did you know that the bubonic plague is still around these days?
Yeah, it's back. It's
It's
making a
amazing.
resurgence. That's, hey,
There's about 1,000 confirmed incidences in the US every year, except today. Instead of dying, like even kings and queens did back in 1348, you go to Walgreens or CVS, get to it early with
yeah, there
antibiotics.
was no CVS back then for
You're
a
good, right?
vaccine.
So it's a great time to be. And I know we have a lot of issues to talk about, but
Well,
this
I would
this
just say
short.
that's a great precursor to basically saying this economy, this country has a great deal of resilience. And looking
Yes,
forward, there's a lot of opportunity. Then, and some of it's hidden, some is right out in the open. What would you
yes.
say right out in the open opportunity is right now for the commercial real estate market?
So this does represent a little bit of a risk, and it's going to be counterintuitive, but specific markets and specific assets, I actually be even looking at the office sector bouncing back, right? Again, this is going to be incredibly conditional. I don't think anyone mainstream investing is out there saying it's really time to pile back into office, right? But I think in general, redemption queues have shortened or stopped for a lot of funds that are mostly office. Things have stabilized even from a valuation point of view. So if you take a look at NCREIF's numbers, I believe even capital or appreciation returns for the office sector have turned maybe mildly positive. I've forgotten, right? So Q4 just came out earlier this Monday. So let me make sure I'm remembering it right. But it does look like we're at the upswing or at an inflection point. I'd start taking a look seriously at some of these markets where, especially where there are like true enforceable mandates and buy-in towards return to office. I'd say New York, right? I just happens to be the largest office market in the country too. It will still feel like a counterintuitive play, right? It's probably not the safe play, but that's one thing. The other thing is it might be a near historic opportunity right now with the disruptions in multifamily and still a good amount of supply coming online to take a serious look once again at possibly good repriced assets. And the reason why I say that is I think a lot of folks noticed that in Q4, multifamily appreciation returns in NCREIF went negative. It
Mhm.
followed rent growth that has been tepid or negative for many markets. Now, don't get me wrong, multifamily still has amazing near to long-term prospects, but in the short run, there might be some disruption where might be well-priced assets you might have to go off market. that might be attractive at this point. Whereas I think for a long, long time, especially in multifamily and logistics, you had to kind of fight at the bottom of the barrel, right? They're all like super tight cap rates. Everyone's just piling into those property types. We might see a little bit more space in the competitive area for those.
Okay, so this was actually one of the questions I'm going to touch upon, and we have a great question to lead right into it. Data centers. Okay, and that has been a big, big boon for investment, for real estate. Some of it balance sheet, some of it fund management, some of it private enterprise, and it's getting beaten up at the same time. I'm not getting into the NIMBY stuff and all of that, but is that a viable, or is it already, is it the life sciences of 2026?
It's amazing that you use that analogy, Jonathan, but it's also quite appropriate because, as we know, for things like life sciences, medical office, medical research, right? A whole lot of customization needs to happen to these properties. It renders a lot of these structures as relatively immutable, right? In other words, what's the alternative use for R&D space if your tenant leaves and the next tenant really needs a full custom? A teardown or massive TIs, right? And I think that's right now the wave for data centers is very much tied to all of the investments in AI. That I'd be surprised if someone hasn't asked about AI yet, right? So
It has. That's why I bridged this question.
right,
So
right. So exactly. So I think it's true that right now we are riding a massive wave of investments in AI that's been keeping GDP growth up. That's a big component aside from consumer spending, right? And it's also true that there's been a little bit of a shakeout in 2025, but if you take a look at the valuations of the so-called Magnificent Seven, I think they're up to an historic high relative to the S&P 500. If you just take a look at the seven big tech companies, I think they're close to 20% of total market cap because of just the way they've grown,
sure.
right? That's just the way the cookie crumbled. And my worry for that is that usually it's not the case that everyone in a race for new tech platforms wins. Right now, the market seems to be valuing that everyone will win. Usually there will be a shakeout and say this is going to be the dominant platform, at least for the near term. And the others, I don't know, sorry, Netscape, right? It's gonna be Internet Explorer for a bit, right? And then Google Chrome will come by, and I don't know, Firefox, it seems to be faster, right? So the cycle of technology is such that there tends to be a dominant platform that holds on for a bit. Right now, I think we're still well, let me ask you, Jonathan, do you play with like large language models, even just on your phone for
No,
ask
I
questions?
don't.
Not at all.
I don't. I mean, I do ask questions, but
Just that, right? Yeah.
I just type them in. I don't even use the voice yet. So I'm
So,
definitely
but you use like Chat GPT or
yeah.
something. What's your preferred?
I
What's your
use Google,
go-to?
whatever their
Gemini. Yeah.
Gemini.
So you use. Why did you use Gemini? And just curious. It's
It
not
was the one
advanced.
that popped up.
My brother-in-law would be so happy. He's a Google employee, right? He is
I
very
will give him
brand.
a call.
He's
I'll give him a call afterwards.
Yeah.
But
He
one of
gives
the
me the
questions.
side eye when I say I use Chat GPT. But
So,
I think this is interesting right here. You and I were using two different platforms. I typically I correct Chat GPT every week, by the way. It gets stuff wrong. You know what? A lot of these large language models, the way they work is with token. And we're not going to go get into the tech here, but there's a massive incentive for them to give you some answer, even though it's not right. That's what you'll hear
yeah,
as hallucinations, right? And it's true. I've literally caught these chat programs like making up like episode titles of shows
yeah.
that doesn't exist. And then I'll call them on and you made this up, didn't you? And they're like, you're right to call me on that. I'm like, why, why did you do that? So
Why'd you do that? So one of
we,
the questions that came
yeah,
up was, how concerned should we be about the percentage of GDP growth coming from AI, including off-balance, non-transparent financing sources and obligations? Is like, who will be the winners, who will be the losers? I mean, AI is a big part of our GDP growth in the last year,
that's
two
right.
years.
So,
So
so the
ultimately,
shakeout
that
is
will
yeah,
shrink.
the shakeout is yet to happen, right? And hopefully, the big hope is, if you're an optimist, is that once a platform that wins is truly accepted and integrated, it will result in so-called productivity improvements, real productivity improvements that will unfortunately lead to some people losing their jobs, but on the whole, a more productive society, quote unquote, with an economy that's growing, not reliant on just AI. That is the positive hope. I think it will take us a while to get there, or it will happen in a crash, right? And then there will be a lot of pain. Hopefully, that pain is, acceptable. I don't know if you want to bleed through it. I don't know if you want a massive, just to cut your limb off and get it over with. But I suspect the
A
reckoning
little
is still
grim.
to come.
Okay. Yes.
I
Uh,
suspect the reckoning is still to come here. And just take a look at the valuations of the largest companies, right?
yeah.
They're still priced like everyone is poised to win the race. And I just don't
It never
quite
happens that way. It never
no,
happens.
I don't quite see a multi-modular solution. If you think about dominant niche platforms, maybe the trend towards deglobalization and regionalization will help with quote unquote multiple winners. That sounds really vague, but this news item yesterday just hit my inbox that claimed that France is going to switch from Microsoft Teams and Zoom, right? So they have an in-house, quote unquote, in-country French developed platform for video conferencing and communications. And their announcement was basically that, oh, for reasons of national independence and the usual stuff, right? We
Yeah.
don't want
Yeah.
to be dependent too much on American technology. They're switching. So in a world like that, you can conceivably come up with a scenario where, oh, Microsoft is dominant in the US, but in France it's something else. I think you do see it in some apps, right? So I don't know if you use messaging apps like
Yes.
WhatsApp, right?
What's that?
So you cannot even go to Europe without WhatsApp.
Right.
When you get off the airport and you're waiting for an Uber or your car, you communicate via WhatsApp. You communicate with the tour company. It's a restaurant. It's all WhatsApp. But WhatsApp is nowhere in China because it's WeChat, right? It's very limited in Japan because Japan uses Line. And then the Philippines likes Viber. So there is a regional network effect. If you're first in that market and enough people use you, then that's all folks are using, even if it means there are multiple providers, right? So I think you can see that in other technologies, but I don't see the same for things like AI right now. So
It
we
really
shall
worked.
see how it evolves.
It really worked for MySpace.
Yeah, exactly. Or Friendster. Please write
Yes.
me a testimonial or something like that.
Another
Uh,
question that came in is please address the possible dangers of a K-shaped recovery.
Well, I mean, it's the basic premise of like using different letters in the alphabet for said recovery is that it's not even, right? Some sectors are growing, some sectors are actually declining. I think Mark Zandi and the Moody's folks put a lot of thought into this. And I remember latter half of 2025, they basically noted that the US economy, about 23 of 50 states are likely to be contracting. I don't think they used recession, right? But they used maps with reds and greens, and a lot of them were red, right? And so, hey, what did I say? The US is growing by 2% net on average, but that might mean you're in a state, right? 23 over 50 probability that it's contracting and that it's actually shedding jobs. So that is always the risk of an uneven recovery. I do think
Mm,
many recoveries in the past. Do we even call this a recovery? We didn't have it. The last recession we had was during COVID, and that was
yeah.
self-imposed because we shot our own heads, right? So we didn't have a recession. What are we recovering from? But I think growth in general has been uneven. That's why we apply K there. Some are going up, some are going down, right? And it is a concern because it's going to encourage inequity. There are going to be some winners, there are going to be a lot of losers. In the past, in a well-functioning system of checks and balances, the government would be in charge of redistribution, right? It's like, oh, all you entrepreneurs making a ton of money but making capital bets. Great, you should be rewarded for the risks that you take. That's amazing. But we will also tax you so that the wealth that you've created can also support folks who were not as fortunate. But I think even that is being cast into doubt when it comes to things like prioritizing where our, $4.8 trillion budget is destined to go. Is it truly redistributive, or is it actually regressive because a lot of folks are going to be kicked out of Medicare and it just kind of happens to be the poorer folks, right? So, in a well
Always.
functioning system of checks and balances, there's a way to kind of even that out, right? But right now, even that I think is cast into doubt, which is creating a lot of anxiety. And despite again, I said 23 might be in the red. The 27 states that are growing are still pushing the country to
Sure.
positive growth, right? So I just want to be fair about just what's going on here. Like a lot of folks check their 401k and you're like, hey, what's the problem? It's been great. I think everyone's asking what kind of runway are we looking at though? Or do we just get lucky last year?
So here's the question that always the big question. Will interest rates go down further in 2026?
That's a great question. And usually when I'm asked that, my answer is what interest rate, right? And so if you take a look at short-term interest rates for commercial real estate, take a look at your 30 or 90-day SOFR, right? If you're in the credit business, you'll probably use that to price your loans. It's already come down. Spreads have tightened quite a bit. And if you just graph the data for the 30-day SOFR, 90 days. So before that, LIBOR, of course. So you're going to join those lines back in
Yeah.
2019 or so when we made that migration. It is 100% correlated with the overnight borrowing rate from the Fed, right? So
Okay.
whatever the Fed says, what is the 30 to 90, 60-day SOFR right now? Oh, surprise. Is it close to 3.5, 3.7? Yeah, because that's the Federal Reserve's overnight borrowing rate. And so it tracks pretty closely. I'd say the short end rates have in fact come down, right? But what's interesting is that the long end rates have stayed really up, right? So you've got your 10-year treasury once again, which is a typically used real estate benchmark, quote unquote, stuck at around 4.1, 4.2 since late last year. It dipped to maybe 3.8, 3.9, but I will share this with you guys. We did some very basic research. Volatility in the 10-year treasury has in fact been falling since 2022. So let's quantify that, right? Volatility meaning max minus min, the largest
Mhm.
value in the year minus the smallest value in the year. That spread has been narrowing since 2022. Take a look at the standard deviation. It's also been declining since 2022. And we just cut rates in 2024, right? So on a day-to-day basis, folks feel like, oh my God, the 10-year, it's really volatile, right? It feels like that, but over time, it's actually been stabilizing. In a sense, we're getting used to or letting this whole higher for longer settle in. And by the way, a 4.2% 10-year treasury is still not, you tell me, Jonathan, it's not,
I mean, we remember the interest rates when they were 18, 20%. And
oh, well,
so, I mean, it was a long
exactly.
time ago, but I will say this, real estate persisted, survived, and thrived even
We
after
did
that.
we were doing business in the 80s, right? I
Yeah,
mean,
of
I don't remember. I was very busy watching He-Man and the Masters of the Universe from
course you
1983
were.
to
Yes.
1985, right? But yes, deals were being made. You can even characterize that time as negative leverage, right? That term
Right.
is back in vogue when rates rose and cap rates were so low, right? But what do you think was happening in the early 80s? Look at the cap rates in the, well, who knows who was calculating cap rates back in the, it was pretty much rates were higher than cap
They were
rates
just
back then,
higher, right? And people
right?
knew how to do business then. And I think we just need to put on some new, dust off old tools or learn to use new tools. But
I, so I'll give you our prediction. Our prediction is that at some point, if the overnight borrowing rate and short-term rates decline to what the Fed sees at around 2 to 2.25, right?
yeah,
We're not there. We're like 125 bips away.
yeah,
Canada is there. It's at 225, right? We believe that long-term rates, if we maintain the current, slope of the yield curve, meaning short to long term, right? Then if we maintain that current slope, then the 10-year treasury may fall to a reasonable 3.5, if that makes sense, right?
yes.
So you've got the short-term rates currently at 3.5, 3.75, falling to 2.25. and then the long-term rates coming from a current 4.2 to maybe 3.5, right? That's 5 years off. I think that the
5 years.
next, I think that, you buckle up for
I think everybody
2025.
should just take a deep breath and say, just understand. Victor says 5 years. So
That's right, because our call is that the Fed will pause. I know I'm not just going off what they decided
I
yesterday
know,
because they
I know.
did pause, right? We're pricing in maybe 0.25, zero point 0.5 at most in rate cuts this year. And that's if they really get worried about the labor market's collapsing. Maybe we should talk about like what's the I'll give you a fun statistic if you want to become extra
Sure,
anxious,
sure.
right? Our average job creation for 2025 of under 50,000 per month is the weakest rate of job creation outside of a recession this century. So if you the only times when we created less jobs were during recessions when we were shedding jobs. We are literally treading water in the job
Yeah.
market.
Okay.
And
And you
this is
said
related.
50,000 and below, right? 50,000 and below. Is that what you said?
Well, the rate, I think it's something like 49,000 average per month over the 12 months of 2025.
Yeah.
And yes, we can talk about whether we can rely on BLS data given declining response rates and all that. But we can footnote that. If we trust that number, then the labor markets are treading water. And in my mind, because of statistical margins of error, right? Plus minus basically did not create any new jobs in 2020. That's just it's within the margin of error of zero. Does that make sense?
Yes, yes.
It's so weak. In other words, here's my worry, and it's related to the K-shaped question. It's related to the possible implosion of AI and equity market valuations, right? If we're relying on that wealth effect and investments in AI, and we're not actually creating new jobs, if we're relying on people continuing to spend, right? And we just get knocked off a bit in the labor markets. I don't know about you, John. If I lose I'm going to cut my spending.
Yes, of
We
course.
haven't been shedding jobs overall, despite the, announcements by Amazon lately and
Yeah.
so on and so forth, right? So people are always, but gosh, it won't take much to knock us off the perch. And that
Well,
I
that's
think is
that's a really important. I think that's kind of the sentiment of some of the questions that have come in is
it
sort of
feels
like
fragile, doesn't it?
the
It just
fragility. It's not even the uncertainty, but how stable is it where we are? So which brings me to what you do for a living, right? I'm just
okay.
going to get you're a chief economist. You're at a very large investment management firm. You almost have to play referee and therapist at the same time when you're dealing with your investment committee that brings a deal to the investment committee or
That's right.
brings it further up to the institutional investor that's backing you. Then you've got the other side, the people that are raising the capital. How do you make all of these? How do you manage these constituencies, especially in a volatile environment like this? Because it is volatile.
We
We can
have
all
we
agree
have
on that.
yeah. We have to communicate, and honestly, there's a lot of back channel conversation. It's true because people are coming from different perspectives. They have different look, I'll give you an exact example, okay? What if you're in a multifamily market right now and you're an asset manager for a market that's experienced, this is going to be easy, historic oversupply over the last 2 years, right? Or even logistics, right? So now you're an asset manager and you just lost a tenant, right? And then you're looking at the face rents out there and the effective rents out there. You're like, gosh, we're really going to have to offer concessions, right? In fact, we think effective rents are going to fall this year.
Right.
Okay. Then this research guy comes along wearing a black shirt, eyeglasses, a blue coat, right? And then comes out and projects, along with the acquisitions team that wants to do deals, right? That logistics rents are likely going to be 4, 5, 6% per year because it's going to be a bit on, e-commerce is out there. The tariffs haven't bit. It looks like for this particular market, the logistics, but you need to settle on one number, don't you? But if
Yes.
you're the asset manager, you're looking at the market going, man, that rent's actually negative in my mind, right? Whereas the acquisitions guys, they're never going to take a negative rent growth. They need to make a deal happen. And so I think in those situations, which have definitely become more common in this K-shaped growth economy, we're gonna have to just talk and talk about scenarios. I don't mean about keeping many sets of books, right? You're just gonna have to agree on one view of the truth, right? That's the job of research. But I still think I'm a little bit fortunate that I'm not solely in the risk function, right? Where a
Right.
colleague of mine joked and said, well, you're in research. In risk, my job is easier. I just say no all the time. And I'm like, but you can't say no all the time because literally investment management is about doing deals.
Right.
Your
With all
career
the
by
people that
going.
are on this call right now,
So
right?
exactly. So what do? You can't just like sit on your finger. So I think at times like these, I think we all have to acknowledge that it is a team effort. It can't be one person or one team just saying this is the way it's gonna go. That's why investment and credit committees are important. And more than anything, I talk about scenarios, right? Even in a segment that's booming like private credit, right? There's clearly opportunities to be made. There isn't going to be like a lot of credit funds out there if there wasn't, right? The expertise and execution and structural downside protections, that is even more important at a time when things are booming, right? So, in other words, great, like that mezz loan looks great because banks aren't lending, right? But man, you better structure that deal so carefully for the downside, whether it's warm body clauses and so all that stuff.
Yeah.
Just to really think through that or ask like really important questions like, okay, there are four assumptions that need to happen to make this deal work, right? What would happen if assumption number one fails? What would happen if what if two out of four fail? What if three out of four? So it becomes this Socratic dialogue in my mind where eventually you might still disagree, but at least you really tried to communicate and just take a look at every perspective possible. And by definition, you're not going to catch black swan events, right? That's the whole point.
The black swan events, you can't
Yeah,
predict them.
yeah. So it's like, oh, let's forecast back to black. By definition, you're not going to be able to expect them. There are supposedly, for example, viruses out there in the India and Bangladeshs of this world that have a 70% fatality rate. Bro, I'm like, let's not even talk about that right now. But that is some, I think for those in research, our job is to provide people the map. Okay? This is the landscape. There's a mountain here. There are streams here. Watch out for the alligators on the right. Okay? But if it's the strategy, and that should be where we collaborate, right? That tells you where to go. We can take the risk of the alligators. We don't want to climb the mountain. Does that mean we go here? We don't
Makes a
go
lot
there.
of sense. And this is kind of feedback from what you were saying from another person in the audience. Does that mean, in other words, be a sharpshooter, go back to the basics, understand what real estate really is?
I think so. Like, what are your drivers? Be very, I'm preaching to the choir here. We're in real estate, right? But we talk about global and national trends. Man, real estate is inherently local. Talk about the asset. Talk about what's around the neighborhood. What I like doing in site visits is actually going to a nearby Wawa or going to a nearby Publix or going to a nearby Bucky. Oh my God, Bucky's. Bucky's is epic. Have you been to one,
I have not
Jonathan?
been to a Buc-ee's. I've
Oh,
never even heard of a Buc-ee's. Is
it's
this
out
from
of
Ohio or
it's
something?
out of Texas, right?
Oh,
So they
wow.
build big out of Texas, but it's been making its way up north, right? But if you are by the New York, New Jersey area, there's literally a sign on I-95 that says, "Did you miss your Buc-ee's? Just turn around. It's 526 miles."
Oh, it's right,
Right? So
right around the corner. Yeah.
you're South Carolina. It is if 7-Eleven and Wawa had a baby and then you put them on steroids, since that's Bucky's. It's epic. So
Okay.
anyway,
Note to
I
self.
like driving to the nearby Bucky's or Wawa and asking the attendant about the neighborhood. Have you heard of this neighborhood? Isn't it? The local intelligence from no, dude. Your broker will say this is the next big thing. The locals are going to say no, you stay away from that place, man. That's where buys are made, right? So
Okay.
I think I think it echoes what everyone else is saying about it. You know what you're doing. Get back to the basics. If
Okay.
you're looking at senior housing, man, you got to parse it down and say maybe independent and like active living works. But once you get into memory care and skilled nursing, where services are a much bigger component, it's not. Is it still real estate? I think we've always asked those questions, I think.
Okay.
But for data centers, I think this isn't quite. Is it real estate? Is
Is
it
it a
infrastructure?
utility? Is it a
Right?
utility? Right.
So
Wow.
I think I think, or in my mind, if I was lending to a data center, what's going to happen if it becomes a stranded asset? What's the use of it? What's the convertibility of this? How fungible is it? I haven't gotten a straight answer from the data center optimists about that, by the way. They're all like, no, 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 we're just going to continue growing. It's going to be awesome. We're going to need more, like, however they measure their power output these days, which changed from last year. So I'm not, look, I own, for the record, I own some tech stocks, right? Who doesn't? I like bubbles. I like asset bubble. My daughter's going to college next year, Jonathan. I can't believe you saw her board, right? When
I know. I
came
know.
friends then.
Wow.
I need those asset bubbles. I just need to exit before they
Yeah,
pop,
well,
right?
that's always the timing's on the buy, as we know. So as we're coming to a close, you always give us some predictions for what the year is going to look
Ah,
like.
yeah.
So so why don't you put up the chart? Because I have a prediction as well.
Okay, so this is what I like to do. I don't want to be these eggheads, some eggheads on CNBC that make basically non-testable or non-falsifiable predictions because they could be wrong. And then the next day they could just be back on TV explaining why they're wrong, right? So when
Yes.
I share these predictions, I want to emphasize, do you see the screen, Jonathan?
No, I don't.
Here you
Oh,
go.
I do now. It's coming up.
So I want to emphasize that they are in fact testable predictions. And if the counselors will have you and I back later this year, early next year, we can flash these up again and just determine what we got right and what we got wrong. Okay? So number one seems a little bit obvious, but at least I give you the metric by which we'll measure it. I do think policy uncertainty will remain heightened relative to historical averages. I wish I had the chart here, but we actually hit based on the Economic Policy Uncertainty Index. This is publicly available. Just search for it. A bunch of good academics generate it and maintain it. We actually hit a record high for economic policy uncertainty in April of this year, as in higher than the pandemic years. And I'm like, wow, really? Like people felt more uncertain about policy during Liberation Day than during March of 2000, March of 2020 when we shut the whole world down. That's pretty amazing to me. I don't think we're up at those levels, but I suspect relative to historical averages, they will remain elevated. Number two, I had mentioned this earlier. I'm betting that the US 10-year Treasury settles between 4.0 and 4.3. It will also exhibit less volatility, so you can measure that, max minus min or standard deviation. That will continue to go down as we settle on this so-called new normal of higher for longer on the long end. And then I had hinted at this as well. Your total returns numbers across property types might surprise folks. I think you might see retail and office total returns as measured by NCREIF NPR Odyssey outperform multifamily and industrial because of a variety, whether it's tariffs finally taking a bite out of logistics or that soft rent growth from multifamily or maybe sponsor slash specific idiosyncratic loans blowing up. We're seeing some of that in some multifamily loans, particularly the ones that were originated in 2021 and that need to refi now. I think it's idiosyncratic, but it will likely weigh down total returns for even this. I'm not saying I'm down on multi. In fact, we're still making investments in multi, but in the short run, it might be a bumpy road. The fine print, which I intentionally put in smaller font, right, is this is all assuming we still grow between 1.5 to 2%. We don't enter a recession. If we do, this is out the window.
Okay. All
Back to
right.
you. What's your prediction, Jonathan?
My prediction. Okay. The national vacancy rate, according to Yardi, is between 19.4% to 20.5%. That's nationally. Obviously, each
Across
province
all
is
properties or office?
office.
All property. Oh,
Office.
office,
Just
office.
office. I believe the vacancy rate will go down to between 18.5 and
That is
19.4%.
very precise. I love it. So first of all, directionally, you think it's going to go down.
I do.
So you and I are actually on the same page where I'm like, you should be looking at office this year. Might
As
be
as
sure. Okay.
as I think it was Peter Linneman that said, if you want to make money, invest in real estate. If you want to make a fortune, invest in office.
That's very interesting. No, so I have not heard that quote, but I
At
obviously
least I think I attributed it to him. Now, finally, as we're closing, last year I asked you what your favorite holiday movie was, and you had a few. But I'd like to, as we look at 2026, movie, book, or song that could basically tell you how we should approach 2026.
Really? You're really asking me this? How we should approach
Yes,
2026?
what will the year look like?
Okay, I'm sorry.
I have a song too. Okay, so
This is a very topic du jour because folks in real estate still need to put one step in front of the other, right? Despite all this uncertainty and volatility, right? I believe in agency. I believe in getting things done. So I believe in taking control and owning your power. So the movie that I recommend is the upcoming Masters of the Universe movie. That's right, June 5, 2026. It's gonna
so you
really
know when
be
it's coming
released.
out. Okay, there you
This
go.
is going to
Masters
be
of the Universe.
He-Man from 1984 raising that sword saying, I have the power. Back to
Wow.
you.
See, owning your own power. I'm gonna go a little retro. I'm gonna go to David Bowie,
Oh
and
my.
I'm gonna say the song that we should that is gonna be predicative for me is Changes. Turn and face the
Oh,
strange because we are gonna have some hell of a year.
that's amazing. That's amazing. Well, Jonathan, it's always a pleasure. We need to do this in person at some point. And if not,
Absolutely. We tried.
we
We
need to meet in
tried.
person, right? We'll do it. And I hope for the best for all of us. And
Absolutely. Yeah.
everyone listening, thank you for your time. I really appreciate it.
Thank you on behalf of the counselors of real estate and for our fellow counselors with us today. Please plan on joining us for our annual and free SIG Palooza beginning next week, February 5th, and continuing through February 17th. These 1 hour interactive sessions will focus primarily on the top 2026 top 10 issues affecting real estate. Bring your perspectives and questions to one or all of the 12 exclusive forums. Watch your email for details or register directly at CRE.org and join us on February 19th for our next webinar, Four Continents, Four Perspectives. I don't think Antarctic is part of that, but you may register at CRE.org. On behalf of the Counselors of Real Estate, thank you for attending this session. What's next for real estate and the life experience? Victor, thank you.
Always a pleasure, Jonathan. See you soon. Bye,
Take
guys.
care.
Bye,
Bye.
everyone. Take care.